A trailing stop loss order or a trailing stop order is a risk management tool that allows investors to lock in profit as the price of a stock rises while still protecting against a significant downside. The order moves up for long positions or down for short positions with the market price but remains at the fixed distance, offering flexibility and automatic profit protection. And so we are considering how to use trailing stop orders to protect profits in rising markets. How you could utilize trailing stop orders to protect your profits in a rising market. So we want to consider how trailing stop orders work. How trailing stop orders work. For long positions, that's for position you are holding for the long term, for the stocks you bought and you want to hold it for the long term. As the stock price increases, the stock price also rises. But if the stock price drops, the stock price stay the same. If the stock price falls back to the stock price, the order becomes a market order, and the stock is sold. That is how it operates. All right, so it can move along on an upward trend. It can also move down, on a downward trend. And so once that particular price you fix, is attained, it becomes a market order, and then the stock is automatically sold. Then for short position, the stop price is set above the current market price, and as the stock price drops, the stop price moves down. If the stock prices rises, the stop price remains at the last position, protecting against a significant increase. Protecting against a significant increase in the stock price. You discover that that particular price is maintained, and in that case you have a target in mind, you have a goal in mind, you have a price you want to exit your trade right from the word go, because it could help you to be able to mitigate risk when it comes to trading. Examples of using a trailing stop loss order. Example of using a trading stop order. So let's look at how this order type is utilized in the markets. We want to have a very clear-cut idea of how it is used. You buy a stock for, let's say, let's use $50. All right, you buy a stock for $50, and you set a trailing stop order with a $5 distance, below the market price. All right, you bought it at $50, and you set a trailing stop order with $5 below the market price. Now, if the stock rises to $60, the stop price will automatically move to $55. In that case, it is 5% below the 5% below the new high. Now, if the stock continues to rise to $70, the stop price moves to $65. Now, if the stock then drops to $65 or below, the trailing stop orders will trigger a sell, and then you lock in your profit. In other words, with this kind of order, you will not sustain a loss. You will not, because once it gets to that particular price target, you discover that the system will automatically sell your shares, and you could always lock in your profit. That is, the price will never go below your initial buy price of $50. So as the price moves up, the stock lock the trailing stop orders move alongside the price, and as the price drops, the trailing stop orders equally move down, but they can never move below the $50 at which dollars at which you bought the stock. It is utilized to be able to lock in profit without losing at the end of the day. So benefit of using trailing stop orders. Benefit of using trailing stop orders. The key benefit is to lock in profit. When it comes to investing, if you don't set this kind of order, you discover that you bought a stock at $50, the stock climbs to as much as $70, and if you don't really put in this order type to sell, in fact, the stock can even drop to 60, to 55, to 50, and even to 45, and you're not able to, take profit when it was around 60, 65, 70. So you like this particular order to lock in profits. So as the stock rises, your stop price rises with it, locking in profit without having to monitor the stock continuously. So once you keep putting this particular these trailing stock orders in place, you don't need to bother. As there's profit, it will lock you out, and then you could take out your profits. Number two, automatic protection. It offers automatic protection. Trailing stop helps you automatically protect profits without needing to adjust your stop manually as the price moves up. So automatically it protects your profits without you having to manually key in the order any further. Number three, there's flexibility. Unlike a fixed stop loss, which remains static, the trailing stop adjusts dynamically, allowing you to capture more upside potentials if the stock continues to rise. So in this case, discover that since it is a trailing stop order, it's a trailing stop orders, you continue to trail the movement of the stock. All right, and your stock is climbing, it trails the stock movements, and then it will get executed at your desired point, at your desired price. Number four, it prevents emotional decisions. So once you key in this particular order, you may not really have to decide. Your emotion doesn't come into the play any longer. By automating profit protection, trailing stop prevents emotional trading and help you stick to your strategy. Let's consider best practices for using trailing stop orders. Best practices for using trailing stop orders. Number one, choose the right distance. So set a trailing stop with an appropriate distance from the current market price. If the stop is too tight, you may get stopped out by normal price fluctuation. If it is too wide, you risk losing more profits during price decline. So make sure that it's not to the gap you are fixing between your desired exits and the market at the point at which you bought the stock is not too wide. Number two, consider volatility. More volatile stocks may require a larger trailing distance to avoid being prematurely stopped out during normal market movements. Number three, use in conjunction with other strategies. Trailing stop works best as part of a broader strategy that includes diversification as well as some risk management technique. Let's look at the limitation of this kind of order. There's no guarantee of execution price. There's no guarantee that you could exit the market at the price you've earlier set. As with regular stop loss orders, the execution price could differ from the trailing stop price, especially in a fast-moving or illiquid markets. Number two, market gaps. In the case of significant price gaps, the stop could open well below the trailing stop price, resulting in a sell at a worse price than expected. You could end up selling disposing your stocks at a price worse than what you could even imagine. So in conclusion, trailing stop orders are a powerful tool for protecting profit in rising stocks by automatically adjusting as the stock price increases. So you just set it as the stock price is increasing. It is the trailing stop loss, the trailing stop order keeps adjusting itself until it gets to a point where it would sell out the stocks as earlier expected. So it's another that is very important. It helps you to lock in your profit so that you not end up accumulating paper profit and then selling out at a loss. It will help you to lock in your profit. You don't have to you will not lose anything as a result. Please subscribe to this channel and make sure that you like this video so that it encourages me to keep on bringing contents of this nature to you.